All right. Well, it's 9:30. I'm a big believer in starting on time. And so Andy and I thought we could add value to real estate professionals, just by education, not selling, but really trying to help you guys, you know what we think you should know about lending, right? Your real estate agents, be great at what you do. We're lenders, we'll be great at what we do. But the purpose of these monthly Zoom calls is just purely education. All right. So, if you guys have questions, while we go through this, I mean, certainly just speak up, don't hesitate. Right. So on this first one, we thought we'd go over the buy before you sell program, and then just a quick refresher on seller concessions, since that's so topical with the NAR settlement, and then temporary rate buy down options. So generally how the buy before you sell loan program works is, and we have two investors that we do these loans with. So they will give the home seller, they will give them some of the equity out of their current home. Okay. They normally will go up to like 70 or 75% of their estimated value. Okay. So they will give them that money, and then the sellers will be able to use that money for the purchase of their next home. Right. So they're able to obviously buy before you sell. One of the great things about it is that the buyer is now able to make their offer that is not contingent on the sale of their house. Right? So that they're now more likely to get their offer accepted. So not only is that offer not contingent, from a qualifying perspective, we are only qualifying them with one mortgage, which is, the home that they're buying, right? So it gives the buyers, the sellers, more time to move, and so even though it's called buy before you sell, it's really just a bridge loan, right? A few things, it must be primary residence to primary residence, right? You can't use it for second homes or investment properties. I already said they'll normally go to 70 or 75% of the value, right? The money's provided at 0% interest. There's no payments required on the bridge loan. And then the buyer is given several months to sell what we call the departing residence, right? And what I think is the best part is for you guys, because I feel like in the real estate industry, agents are being cut out so much, and the best part is you're able to earn, two full commissions. You're able to earn the purchase commission and the sales commission. So the investors do not want to purchase these homes. They want you to sell these homes at full market value, get as much as you can get, right?
They don't want to buy they don't want the house. I think they
Mhm.
told me they've done one, and that's just because the seller didn't ever put it on the market, didn't do anything. It was like 9 months later. They want to get a piece of the pie and move on. They do not want to buy the house.
And I'm sure that they've probably done hundreds or thousands of these, and they could probably count on one hand, how many times they were sort of forced to have to buy the house, and that's all across the country, right? So there's two companies that we do these with. You guys know both companies, right? There's Knock, and then there's Homelight. So let me just go through some of the differences. They're very similar, but there are a few key differences which sort of determine which investor we place it with, right? Sort of based on the situation. Okay. So, the whole key to these is, again, they give them the bridge loan, all that stuff. It's just when they go to sell their house, that's when the seller is going to pay for the bridge loan, right? So knock charges 2.25% of the estimated list price, plus they charge another 1,850 just for miscellaneous closing cost on their end. Okay. They will limit how much equity they'll give the sellers. So they only go up to 500,000. And then of that, they will limit it so that they're not providing more than 50% for down payment, right? So if the sellers are buying a $500,000 house and they have 500,000 of equity, knock will only give them 250,000, right? Knock restricts them to that 50% down payment requirement on the purchase. Okay. A neat thing, a neat feature about these is that you can use some of that bridge loan money. You can use some of that to pay off debts, liabilities, sort of in advance to help you qualify on the purchase, right? You can also use up to 35,000 of that money for home prep for the sale of your house. You can use up to 5,000 of that money for moving cost. You can use some of that money to pay for the departing resident's mortgage payment, right? Because there might be a period of time where the borrower has two mortgage payments, right? So if they close on the purchase, let's just say in September, right? You skip October, their first mortgage payment is November 1. Well, if you haven't sold their house by November 1, they'll have two mortgage payments starting November 1. So they can use some of the bridge loan money to pay for, mortgage payments for up to 6 months, right? Which is nice. They give you, the real estate agent, they give you up to 6 months to sell the departing resident. The 6 months doesn't start until closing on the purchase. I mean, so you really have 7 months from now, right? And I talked about it's 0% interest, no payments for the bridge loan money, right? You're just paying 2.25% at closing on the sale. Knock has a max list price of 1.2 million. They don't require any home inspection. The other cool thing about these is 9 times out of 10, we combine these with conventional loans on the purchase. But we can also pair them, the bridge loan. We can also pair the bridge loan with FHA, VA, and USDA. The catch, though, is the government doesn't allow us to exclude the existing mortgage for FHA, VA, and USDA. They're still making a contingent offer, right? So it's not contingent on the sale. But if we're going conventional on the purchase, we're only hitting them with one mortgage, the purchase. If we pair it with FHA, VA, or USDA, we have to hit them with two mortgages. Just makes it a little bit more difficult to qualify, right? Do you guys any questions about kind of the details of the knock program? I mean, it's pretty self-explanatory. And then Andy, if you're okay, I'll do home light just because.
Yeah, go
Yeah.
ahead.
And then again, it's just slight differences, right? So home light charges a little bit more. They charge 2.4%. Knock charges 2.25%. But if you remember, Knock also charges about $1,850 in their closing cost. Home light doesn't. They charge just 2.4%. So the math is pretty similar, right? One really cool thing about the Home Light buy before you sell loan program, they actually have an option. So instead of them pulling equity out and giving you that so that you can purchase, if you only need to remove the contingent offer, right? So the seller's like, look, I have 200,000. It's in the bank right now. I'm going to use that. That's my down payment on the purchase. I don't need to pull out any of my equity. I just can't get my offer accepted with being a contingent offer. So HomeLight will actually say, okay, for 1.5% of the sales price, we'll remove the contingency to sell your house, which I think is pretty cool. They'll go up to, where, remember I said knock only goes to 500,000, the equity that they'll give you, the max amount. HomeLight will actually go to 2 million. They don't have any restriction for down payment percentage, right? Same thing. You can use the bridge loan money to pay off debt to help qualify. They'll give you up to 25,000 cash in hand. Their window is shorter though, which is why I feel like we normally use knock. Instead of giving you 6 months to sell, they're only giving you 120 days to sell. So 4 months, right? They might give you a 30-day extension sort of on a case-by-case basis. I feel like most of the time you'll get it. So really, HomeLight's giving you 5 months, Knox is giving you 6 months, right? Same thing, 0% interest, no payments on their bridge loan. They have no max list price. If you remember, Knock was 1.2 million. They do charge a home inspection fee, kind of in that 600 to 900 range. And same thing, we can pair the HomeLight bridge loan with conventional FHA, VA, USDA. We can also do it with some of our jumbo investors and some of our non-QM investors, right? So as you can see, those programs, the way that they work are the same. There's just a few differences in their parameters, right? There's two. So for the seller who's buying, there are two closings, right? Because they're pulling out the equity in their current home, the departing residence. So let's just say a week before closing on the purchase, maybe 4 or 5 days before closing on the purchase, the sellers are going to sign closing documents, which is for the bridge loan, right? The equity that they're being given, right? It's treated as if it was a cash out refinance, right? So on a cash out refinance, by law, we're not allowed to fund a loan for 4 business days, right? So if they sign on a Monday, we can fund on a Friday. So when we do these things, we sort of take that into consideration, and we're trying to get them signed on the bridge loan documents a week in advance so that they can then fund and we can close on the purchase perfectly on schedule. Okay. Another cool feature, and this only applies to conventional loans, is recasting, right? It's not refinancing, it's recasting. Some people have heard that term, other people haven't. So the example is, let's just say they had 300,000 of equity in their departing residence, and they gave them 200,000 on their bridge loan, right? So a few months later, you close on the sale of their house, and they have another $75,000. All they do is they pick up the phone, they call the mortgage servicing company and say, hey, I just closed on the sale of my house. I have another 75,000. I want to apply it to my loan, right? They might charge them $250. So there's a very small fee. It might take 4 to 6 weeks to do. It's an easy process. It's a little bit slow. But what they'll do is when they receive that 75,000, they'll reduce the mortgage loan, and then they'll adjust the monthly payments based on the smaller loan amount, right? That's recasting.
Usually they charge what, a few $100 to do
Yeah,
it?
I think it's about 250.
Yeah, it depends on the lender.
Yeah.
How long is the recasting window? Is it like within 6 months or 1 year, 5 years?
It's a great question. I think it
Anytime.
depends on the investor, but
Anytime.
I think it's anytime.
Yeah, anytime.
Yeah.
The big thing is you don't want your seller just to send principal in without calling them, because if they do, it just accelerates
Right,
their amortization
right.
schedule. no change the payment, no going back. So
Okay.
they have to call. So whenever we have a client that asks about, hey, when I sell my house, I want to put it towards the mortgage, two things, right? Yeah, we can refinance you when the time's right. Like if rates aren't a lot lower or higher, obviously that's not a good route. We want them to not do that, but we want them to lower their payment. So basically, we say, hey, when you get your funds, call the servicer, get me on the phone if you like. We'll go over what you're trying to do. They tell them how much they're going to send. They'll send them out some paperwork with the payments and things like that to sign, and then they send the money in, and then they process it. It takes a few weeks usually.
I just wondered if somebody like, you know, got some funds from like an inheritance or
Doesn't matter.
something.
Anywhere is fine.
Anytime,
Yeah,
anytime. Okay,
anytime they
thank
have
you.
extra money and they want to put it on the mortgage and it's not good to refinance, they can do it anytime. It doesn't have to be from the home sale, just if they have extra money, right?
Perfect, thank
Um,
you.
the other thing too, that's really important to remember that this is really just for conventional loans. VA loans, you can't do it. FHA loans, you really can't do it. So it's just conventional financing, not jumbo either. Most jumbo lenders don't offer it.
No. Just make sure they use the term recast so that their monthly payments get adjusted accordingly. It doesn't change the interest rate, but it does lower the monthly payment, right? And then Andy, I'll let you handle seller concessions. I mean, I can go to the
Yeah,
next I can go to the next slide.
Yeah, I'm gonna share my screen because I want you guys, those of you who aren't aware of some of the tools we have directly on pricemortgage.com, or even if you click on the application link, there's some links there as well. But wait, put that slide back on, Randy, real quick.
Okay.
I don't see it. It's okay. I'll share my screen. Oh, there you go. Okay. So conventional, one thing about conventional is it's determined by the down payment amount. So if they're putting less than 10% down, the most you can ask a seller for is 3%. That's it. So sometimes we'll see things that maybe there's some, like they want to give an extra credit, but we're already at 3%. Couple ways to handle it. Like a home warranty, that can be a seller paid item. It's not necessarily a buyer cost. So you can throw it on a home warranty. That can be outside of the 3%. Also, let's say they wanted a repair done on the roof or something. Let's say that was $1,000 and they want to just give an extra credit. We can't do that. We're at 3. So we'll say, hey, get an invoice from the roofer, whatever, and the seller can pay that invoice on the seller side. So it's not falling under buyer credit side or on the buyer side of the transaction or closing statement. So there are some ways around that. You just have to, figure out what's the best way to do that if you're at the 3%, max already. And then yeah, if they put down 10%, they're at they can get 6% from the seller. And then once you hit 25%, you can get 9. The big thing though is with investment properties, conventional only doesn't matter the loan to value, 2% max. So if you have a client buying a rental property, 2% is the max. FHA loans doesn't matter, 6% across the board. VA is 4%, but that is not for standard or customary closing costs and things. So really there's no limit for VA how much concessions you can get. One awesome feature about a VA loan too is that let's say the customer wants to pay off a $3,000 credit card or something, or to qualify or whatever it is, we can use seller concessions to pay off debts for the veteran at closing for whatever reason that can come up. I've had it come up before and we used the credit, paid off a debt. USDA, that's also 6% max. Jumbo loans, it will really vary. I mean, some are at 3%, some allow more, it depends. Same with non-QM, some cap at 3. Non-QM is like your bank statement loans, DSCR loans where you're using market rent to qualify to buy the home, nothing else. So those will all vary depending on the investor. So like basically we have a deal going with you and we're doing one of these loan types, we'll have to verify with the investor, like what's the max amount. But generally saying you can usually get at least 3%. Sometimes it's more. Okay, and so let me see.
And then hey Andy,
Yeah.
Just with the new buyer broker changes,
Yeah.
let's just say somebody's putting 5% down, conventional, max seller concessions are 3. There's an agent that I work with that he's always done it this way. He always charges the buyer 0.5%. So he'll get 3% of seller concessions. 0.5% will go towards his commission. 2.5% will go for buyer, seller concessions. Do you think we can keep doing it that way going forward? Or do those have to be treated separately?
No, I think now with the new forms, and I haven't looked at them as good as I should yet, but I believe there's two forms. There's one for the seller, what they're going to pay the buyer's agent, and one for consent, like buyer credits or seller credits to buyer. Can an agent chime in that might have looked at them better than me?
Don't know. But is it going to be in the purchase contract what the buyer's agent is being paid?
Yeah,
There's
that's what.
forms.
Go
There's
ahead.
there's the cab form, which is broker to broker, which is basically when a listing agent, negotiates with their seller and their seller says, "Oh, I want to give 2% to the buyer's agent." So that will be the form that the broker will show the other broker. And then there's another form called the seller compensation addendum, which is when the buyer's agent will ask for the seller to contribute to their commission, and that'll be submitted with the offer. And that's usually for situations where if the seller isn't advertising or offering any kind of compensation to the buyer's agent right off the bat, or if, let's say, the seller's offering 1%, but the buyer's agent has negotiated 2% with their buyer, so they're trying to get the seller to pay for that extra 1%. Does that make sense?
Yeah.
Yeah,
So
no, it does.
Amy,
Yeah.
did you say that the first form is it shows what the arrangement is between what the seller has agreed to pay in total, and then what percent of that goes to the buyer's agent? So there's full transparency?
Correct. So that's the
Okay.
CAB form. So the way that it was communicated, since we can't advertise anything on the MLS anymore, this is the form that you can fill out and you can put it in the house, so to speak, on a stand. So when the buyer's agent comes in, they can see exactly what that seller is offering to a buyer broker. Now, if there's a situation where the seller's like, I don't want to offer anything, let's just say, where we'll see what the offer is, then that's when, an agent can use the other form.
And what did you call the first form?
It's called a CAB form. It's compensation agreement broker to broker.
Oh, like CABB.
Mhm.
Got it.
And then the second form is the SCA, it's seller compensation agreement, and that's the one that will get sent with an offer.
And
Can I
then,
jump in real quick?
Yeah.
Some brokers are opting out of using the CAB form. The reason for that is it can be doubled up. If you have it on a CAB form and then you put it on another form, it's looked at as a double, take. So many brokers, our broker that I'm with is actually opting out of using the CAB.
My broker as well. I'm with West USA, and we've just got notice that we're not going to be using the CAB either.
Yeah, exactly. So I think my broker says we're going to have a whole new round of changes coming up, probably in late fall or early fall, something like that.
and then where
Yeah, and
does
I
a
think
where does a
it
buyer's
depends.
agent go to confirm what the listing agent is paying on that listing to a buyer's agent? Do they have to contact a listing agent, or can they go to the listing agent's website? Is it on their website?
So a listing agent can advertise it on their website as long as their website is not linked to the MLS. That's where the CAB form, I think the idea about it, so that they can put it inside the actual house. But most agents have just, been picking up the phone and calling, or other agents who aren't doing that. They're just sending offers and sending the SCA form, just requesting, what they want what they want the seller to cover their
Yeah,
compensation.
it's just part of it's like purchase price, close of escrow date. Yeah, it's just a term.
Mhm.
And I think
Right.
a lot of it also depends, like you were saying. I mean, some of the listing agents are going to build in something to the buyer, but I feel like it's going to go where I think most will follow the norm that nothing's there. I think that's where it's headed, especially because of that liability there, where it's doubling up commissions, things like that. So I think that's where it's probably headed. So it'll just be mainly that one form, like, hey, build in what you want to get paid, which essentially is kind of the same thing it's always been, right? Like, and I was talking to an agent the other day, and I said, well, if I was listing a home, I would just list it, assuming we're paying a buyer's agent 3%. You know, not that you're going to spell that out, but build that in on your list price. So then if a buyer's agent comes in wanting 2.5, whatever, you've already accounted for it, you know? Or
Much
if they
like,
want to offer over, great. They offer more, not knowing it's built in. So regardless, you've already built in that spread to be safe with your seller. So I
I
think that's, at
agree.
least if I was an agent, I would do that.
I agree. I think it's going to be treated along the lines of like seller concessions, you know, and depending on the market that we're in, sometimes, you know, sellers are offering seller concessions, sometimes they're not. So it's just one of those things that when you're pricing the home, just factor in that you most likely are going to pay something
Up
for.
to 3%. Yeah.
Mhm.
Yeah.
I agree.
Yeah, and I think too, I mean, as far as agents go, if you're a buyer's agent, I would always try to split out what the sellers, and again, the forms should do that now, but even before this all came out and the changes were happening, any agent that I talked to or asked me, I'd be like, hey, just write it in separately what you're getting paid. Don't add it into the seller concessions to the buyer, right? That being said, if let's say they're 0.5% off or they're paying 2.5, you're at 3. Okay, well, if there's enough concessions there from the seller, then that'll, you can just use it from the seller concessions. But I always think it's great to try to split the two things and not lump them into a seller credit to buyer. Just keeps things a lot easier, cleaner. And also I think it probably looks, I mean, if you're dealing with a buyer as an agent, I think it kind of looks better to not look like, it still looks like the seller's paying it, right? Versus them paying it, which I think is important. It's all about perception, right? So anytime you can make it look like, hey, you're not paying this, the seller is, even though it's built into the price, it feels better than, hey, I'm taking your concessions and I'm paying me, you know? So that's kind of my 2 cents. But anyway, Randy, if I
Andy,
can,
I have a
Yeah.
question.
yeah,
So if, say we have an agreement, as a buyer broker with our buyer at 3%, and the seller's only offering 2.5%, and we can get that other 0.5% from the concessions,
yes.
what do we put that on? How does that translate into paperwork?
It doesn't. It doesn't
Okay.
really, there's not really a place to put it. All we have to do is you have to tell us, point it out to us, because we may not, like sometimes we may not get the agreement in the contract. So every now and then we don't have everything. Like we don't see all the moving parts. So if you get an offer like that or you get a contract, when you send it, say, hey, Andy, the seller's paying 2.5, but I'm at 3% with this buyer. So then we know to build that into their loan estimate, that 0.5% coming out of the concessions as a fee.
Okay,
Yeah, like we do with title fees and everything else.
right. Okay, thank you.
Uh-huh. All right, I'm gonna share this
Can
screen.
could I follow up on that too, or do we need to move on?
No, we
ahead.
don't. Go ahead.
Okay, so, I'm, like I said, I retired recently, so I'm not as active as I used to be, so I haven't been keeping up on this as much as I need to. That's part of the reason why I wanted to attend this today with your seller concessions. So let's say previously, a few months ago, I had a listing, the seller was willing to contribute up to $12,000 towards buyers, closing costs, prepaids, all that fun stuff, because they were competing against a new build that was right across the street. They had the exact same floor plan. The builder was offering, 40,000 in closing costs.
Yeah.
And so we had to put that in the listing. So first of all, the seller concessions that you showed on that list that was there before, up to 3% or 6%, or depending on their down, can that still be in MLS if it's just going towards closing costs? Or do we now run into a problem because there's other concessions for to try to cover the buyer's agent's
From what
commission?
I understand, you can advertise that the seller's offering a seller credit for buyer's closing costs. I don't think anything there has changed.
Okay,
Yeah.
Okay.
Now, that being said, depending on what the buyer's offering, like if they're coming in with a conventional loan less than 10% down, the most your seller can give is 3%.
right.
Right. So in other words, that's something where it's like, hey, I understand they're writing this offer, but the lending guideline and the lender will, whoever they're working with, if it's not us, whoever should say, hey, you got too much concessions here. So, hey, we either need to switch to FHA so we can use up 6 if that's doable, or we have to stick within the guidelines.
Okay. Yeah, this list price was like 800,000. So they're offering $10,000 to $12,000. So they're not going to hit that
Not that
threshold.
big deal, yeah.
But I just wondered how that worked. And then also when you guys are working on the qualification for the buyer, are you adding that into some of their costs that they're going to have to come to close? Or can this money actually get added to the purchase price? If they're $3,000 short to pay the buyer agent commission, can that be added into the loan amount so that it can be paid to the agent at close?
No, the loan amount's always going to be limited by what the loan.
That's what I thought.
is gonna
Okay,
have to put
yeah.
in. The only way to increase that is the price has to come up so that more can be financed in, or essentially, you know, if there's not enough seller credit, they just have to bring in the money, or we
Okay.
have to find out another way. Like the 3% cap, that includes any interested party. So like, let's say you already got 3% from the seller, the agent's like, oh, I'll throw in $2,000. They can't, that's from sellers and agents can't, it's 3%, you know?
Okay,
So the only thing that wouldn't count is a lender credit. So there could be something like, hey, we can go up on the rate a little bit and that'll give you some credit or lower some costs so we can kind of eat up that 3,000. I mean, there's always ways to figure things out 99% of the time. Just, you know, you have to get creative every now and then, right?
sure,
Yeah.
sure.
And
Okay,
then Dee Dee, to answer your first question, you know, when we're doing a pre-qualification, if somebody's short funds to close, or like you're going to need 15,000 for down payment and you're going to need 7,500 for closing costs, right? And they like, hey, I can come up with a down payment, but I can't come up with a closing cost.
right,
Then, you know, 100%, you have to get seller concessions, right, to cover the closing cost. In that situation, you know, Andy might do it differently, but I'm going to mark the pre-qual that yes, they are relying on seller concessions.
okay,
That's different than if somebody has all the money, but they want to negotiate seller concessions. They're not relying on seller concessions to qualify. They're just negotiating and asking for seller concessions,
okay.
right? Two different scenarios.
I mean,
Right,
as
and
far
that's
as
important
why-
because when they're negotiating the price back and forth, that's important to see that,
Mhm.
that it is, they're relying on it.
Yeah.
Sorry, Andy, go ahead. What were
Well,
you
I was
saying?
just gonna say, like, for my protocol is if I know that like Randy said, if I know the buyer needs the money, it's gonna be marked. If they don't need the money, I won't mark it. But if an agent says, hey, we're gonna go in and ask for it, can you mark that box? Sure, I'll send them a new pre-qual
Yeah,
letter that shows it.
Okay, thank you.
Yeah, so we're at your direction on that, right? So if you say, hey, we want to ask for them, just mark it required, done. You know what I mean? So, but anyway, on our website, I was just gonna, what's the next screen, Randy?
Or are you going to go where they can do like the
Yeah.
Or so I do get to that, but do your thing. It doesn't
Oh
matter.
no, what is the next screen? I'll get off this. I can stop this. I
Okay.
thought that was the next one.
It's all right. So let me go back to mine. So if you just want to just touch on real quick, you know, you can use seller concessions for different things, right?
Oh yeah. So so kind of going back to what we can use them for, you know, when we're doing the rate buy downs, we're going to calculate, you know, say, hey, if you want to use some of these seller concessions for a temporary rate buy down, which is where like a 2-1 buy down is when the rate's 2% lower year 1, 1% lower year 2, and then it goes to the full rate year 3. The rate's the same. It's a 30-year fixed mortgage. It's always the same. What the difference is, the seller's going to give enough credit to where there's a subsidy each month to give them what would be the same payment as if the rate was 2% lower the first year, 1% lower the second year. So it's literally just prepaid interest. So no matter what lender you're talking to, the buy down amount won't change. It's all based on the rate though. So if our rate's lower, that how much you need for the buy down is less. As the rate gets higher, you need more because you're covering that prepaid interest for the 2 years to give them that subsidy to get that payment down. And then also when you write your contracts, every underwriter wants to see the language that says the seller agrees that the seller concession to buyer, credit to buyer can be used or is to be used towards a temporary rate buy down. That has to be in the contract. So if it isn't, we're going to come back to you after we get through underwriting and say, hey, we need an addendum saying that the seller's cool with that. So that's something to keep in mind. And then some of the other things he's saying here is like, you know, like usually monthly mortgage insurance is very cheap nowadays for conventional. So we don't see this a lot, but there are times where we could use the seller credit to like do a one-time mortgage insurance fee and not have it in their monthly. That can be helpful sometimes for qualifying, or a split. So basically they can pay a portion up front at closing from the seller credit and then the monthly amount's lower.
Yeah, because, you know, Andy, I mean, I've come across this a few times. Let's just say somebody finds the perfect house and it's conventional and their debt to income ratio is at 52, right? We can't go above 50. But if we can get $3,000 to $4,000 from the seller, we can do a split premium You know, so now instead of the MI costing 200 a month, it might be a 100 a month. Now their DTI is under 50 and they qualify for that house.
Correct. Yeah, you
Yeah.
can do that. So there's times when it comes in handy. Some, you know, other things would be like for FHA, there's that upfront mortgage insurance premium of 1.75% that gets tacked onto the loan. So for every 100,000 that they finance, $1,750 is added to the loan. So that 1.75, we could use it for that to keep it not financed. I don't see that often. It's usually not the best way to use the money. Same thing with VA. VA has funding fees as well if they're not a disabled veteran. So, you know, if they're putting 10% down, the VA funding fees 1.25. If it's 5% down, it's 1.5. If it's 0 down and they've never used it, it's 2.15. And if it's 0 down and they have used their VA loan before, it's 3.3%. So it's very expensive. But they don't have monthly mortgage insurance, and it's still a really great loan.
And then we talked about the other two, so I'll go here.
Yeah, the home warranty stuff or HOA dues is great. Like sometimes we'll have a little extra seller credit left over, $1,000, whatever. Maybe we're not using all the money. Like, hey, just prepay the HOA dues, you know, for a long time. And so that's kind of nice too. And then some of the temporary rate buy downs are allowed on rental property, like conventional rental. You can't do any buy down programs, temporary rate buy downs, but some of the, you know, alternative lending or non-QM lenders do allow it. So those are some things we could do as well. All right.
And so, yeah, I just listed the 4 different types, right, of temporary rate buy downs.
Yeah. So 3,
You
2,
know,
1
yeah.
is basically, this is hard to get because it takes a lot of money when you're trying to be 3% lower year one. But yeah, 3% lower year one, 2% lower year two, 1% lower year three, and the same would go for these. 1 is basically 1% lower for 2 years. A 1.0 buy down is basically just 1% lower year one, and then it goes to the full rate. But then I think I can share my screen, right?
Yeah, you can.
Okay. All right, so I'm going to show you some examples. So on our website, we can always run these numbers for you as well. You know, that's not an issue. On our website though, at the very top, you'll see this rate buy down calculation deal or options. Does everybody see that?
Yeah.
Okay. So basically the way you work it is you can say what type of buy down. You put in the loan amount, not the purchase price, and you put the interest rate in. So if you know those things, you hit submit. Pretty sure I hit submit. There we go. All right. So this breaks down the savings. This is just principal and interest, right? But basically you can see here, okay, if your loan amount is 400, that year one is at 4.25. So the subsidy amount or the amount that they're going to save is $495 a month. Year two at 5.25. What happened? Where'd it go? That's weird. Oh, there we go. Okay, so what the heck is going on with this site? It's very dependable. Okay, so anyway, year two, it's 254. So you can see the monthly, like here's the full payment without tax, insurance, mortgage insurance. You'll see the lower payment here, how much they save a month for this. So year one, that's the savings. Here's the annual savings. Year two, that's the savings. So if you want to do a 1 year buy down, you would know that you need this 3,048 number for 1 year. 2 year, you're going to need that plus that. So here's the total amount you need to ask for from the seller to cover that 2-1 buy down.
And you know, just always round up a little bit.
Yeah, I always just say round up just in case there's a change in rate or whatever. And then what's nice is you can click that right there and you can share it in an email. But the other nice thing on this page is that there is the seller concession guidelines. So when you're in there, you can go, okay, are we okay to use that? And like, again, we'll always double check all this for you, but if you need to do something on the fly, you can jump on here and find all this information.
So with that, we're looking at basically $9,000, right? That we're asking the seller to contribute to buy the rate down.
Right.
What if that same $9,000 was used to just do a permanent buy down rather than Is this
Well-
normally something you should do when you're trying to get qualifications? So and when do they qualify in first year payment, second year payment? Where do they qualify?
They qualify on the end rate, the 6.25, because again, that's the rate for the 30 years. These are just,
Okay.
this is just temporary payments. They will not qualify on these. It qualifies at the 6.25.
Okay.
And then
Yeah.
Dee Dee, you know, if we go back to my screen,
I can do a quick.
yeah, I have a screen on it though, where I
then
did,
go ahead.
yeah.
Go
If
ahead,
you
I'll
stop, if you stop sharing, let me, and it's exactly Dee Dee's question.
But Randy, I want to share.
You are
Well, no,
extremely
Randy paid me to ask that question so he could
right.
bump you off.
That's what I thought.
Right.
Freaking
No,
Randy.
no. So, you know, we thought about that question in advance, right?
Yeah,
So
yeah,
if you
we
take
planned.
a $500,000 sales price, 5% down, so your loan amount's 475, 6.875 rate, right? Max 3% of seller concessions. So if you compare the upfront 2-1 temporary rate buy down to the
Right.
permanent rate buy down, right? The 2-1's going to save them $11,000
Jeez.
over the next 24 months, right?
Okay.
And
Okay.
it leaves about a 4,000 left over from the
Right,
15,000.
so he'll put them on and then we could probably come pick up the car and do you have well, you don't have the total yet, but
Who's that?
just let us know when it's done and we'll come get it.
I'll
Somebody's not on mute.
Yeah, I was trying to, I don't see how to mute her. Okay.
All right.
Oh, really? Oh, that's awesome. Yeah, he didn't know yesterday when I talked to him, so.
So the 2-1's going to save them $11,000 the first 24 months, and there's still $4,000 left over in seller concessions that can be applied to reduce, right, the closing cost.
Okay.
If on the other hand you took all 15,000, you know,
Yeah, that's fine. We're going
you
out
could
of
buy
town
it down
Friday
to,
morning
you know, from
and won't be
6.8
back
to
until Monday,
6,
so
right?
that's perfect.
So then the difference between
Yeah.
6.875 and 6 is about 272 less per
Yep,
month.
awesome. I really appreciate it.
Okay.
We're
So if you-
excited.
It's going to be,
All right, thank you.
so if you take 272 per month
Okay, thanks
and
a
times
lot.
it by 24,
Bye-bye.
Okay.
times it by 24, I mean, that's a $6,500 savings. So the 2-1 buy down is gonna save them a lot more money the first 2 years. But there are some people that just feel more comfortable with the security of knowing
Mhm.
that their rate is lower, not as low, but it's lower. There's no risk of it going up, and they don't have to refinance. Right? A 2-1 buy down, you're most likely going to refinance at the start of the second year to, you know, so that your rate's not going up
Mhm.
another point, and you're trying to keep the rate at that second year rate. Right? And
Okay.
the other cool thing about the 2-1 buy down versus buying your rate down, you know, let's just say let's just say for easy math, you know, the 2-1 buy down, you know, was $15,000, right? Which is $10,000 in savings the first year, $5,000 in savings the second year. If you refinance at the start of the second year, there's still $5,000 left in that subsidy account from the seller,
Ah,
right? So
right.
the buyer never loses that money. When you go to refinance, if there's $5,000 left, they'll apply that money towards their loan amount. So they're going to reduce their loan amount $5,000. They never lose that money, right? If, on the other hand, you do a permanent rate buy down, and if rates go lower than that, then you really wasted that money buying your rate down because
You're right.
you're going to
Right. Okay.
refinance there anyway, right? So it's just personal preference.
Okay. I appreciate you explaining that to me because I was talking to someone that's working with another agent that I know that their lender was telling them, oh, no, you need to do this. And I thought it didn't make sense to me. And I explained it just pretty much like you said, but I wasn't as eloquent as you, but it just seemed to me that their lender was steering them incorrectly.
Got it. Yeah, personal preference.
Okay, thank you.
And then, you know, Andy already told you guys can find this easily on our website. You know, and then if you guys notice in the chat, I actually attached a copy of this slide deck, right? So you can download it in the chat. You know, just save it, and then you'll have all of these screens, these cheat sheets.
Yeah, I mean, so yeah, like Randy was saying, buy down can be great and they can get the money back. So if we do anticipate rates going down a lot, right, which we kind of do, sometimes it makes sense to go that route because you are going to get a much lower payment with that same money, even though it's temporary.
Yeah.
So I think it just depends on the customer. But like, I mean, here's live pricing today. I just did like a 780 score conventional, so like you can see here, 6.25, it's about 1% cost. If you throw in another 9 grand, you're going to get down to 5.625. Whereas on the 2-1 buy down, 4.25, 5.25 with the same money. So,
So that, that completes our first training. And again, we're going to do these each month, and each month will be a different topic. So certainly feel free, the topics you guys are interested in jumping on.
Can you
and
attach it again in the chat?
What'd you say, Amy?
Can you attach the screen or the presentation again in the chat? I think I got added in after it was attached.
Sure.
Or if you want to.
No, I got it.
we're gonna send out it might be tomorrow or something once our marketing guy can do it, but we'll send out a link for the recording of this, and we can also put this attachment in that as well. And then you can share it with all your friends if you want to, or you can just have a leg up, however you want to live your life. We don't care. So
This is a really good one. You guys did a great job on this.
thank you. Yeah, I think this is stuff that's useful for you and not just the same old song and dance. That's what we're trying to do, is dig in a little bit on these topics to help you guys just have a little more ammo, on some of these conversations you have with buyers and how you're negotiating your deals. So
Thank you guys.
I just want to
as far before I get off, do you guys provide loans for the land buying, or somebody who does? Because one of my clients is trying to buy land and
we
need
don't
some.
have a lot of options in land in the wholesale space. We have one place. I wouldn't say it's the best place. So we also have hard money, private money options for it. I would say if they can qualify for a regular, like better loan, they can go to Washington Federal or like National Bank of America or some of the credit unions, places like that. But if they can't help them, then we'd be happy to get some options for them.
And hey, Barry.
Yeah.
I think US Bank has the best land and lot loan terms.
Wonderful.
Yeah. Oh yeah, them too.
There's a lady named Melissa Ferger who's been at US Bank forever. Melissa Ferger with US Bank. She's the landlady.
Okay.
Yeah.
And on the same lines, foreign nationals like the Canadians, what do they have to qualify, and who can give them the loan?
We can also do foreign nationals. I think we do more of that than land, right? So we do a decent amount of foreign nationals. If they're specifically Canadian, I think
bulk of foreign nationals are Canadians.
Yeah, right. Yeah. But I'm saying if they're Canadian foreign nationals, I think they're going to get better terms at RBC, right? Royal Bank of Canada, or
Bank of Montreal
or First Bank. I always tell Canadians, go to those banks, you're going to get better terms. But if they're not Canadian and they're foreign nationals, we have great loan programs for foreign nationals.
Okay.
You can do them as second homes or as investment properties. And we do a lot of them as DSCR, the debt service coverage ratios, investment properties. Yeah.
And you offices in Tempe?
We're in Chandler Gilbert.
Okay.
On the Chandler Gilbert, line.
Yeah. Make an appointment and stop by and pick your brain.
Yeah, sure. Just call or text.
Yeah. Thank you.
You got it.
Thank you guys for joining us, and hope to see you again on the next one. And if you have any follow-up questions, just feel free to reach out to us. And appreciate you guys doing that. And we're here if you need us. Okay.
Yeah.
Thanks,
Thanks, everybody.
It was very informative.
Thank you.
Glad to hear that. Thanks again. Have a good day.
Bye-bye.
Bye.
Bye for today.
Thank you. Bye.
Thank you.